Hey traders, today is Thursday, March 5th, and I'm Michael Boutros, Senior Market Analyst with StoneX, here for a quick multi-time frame look at gold. So obviously the headlines have been fast and furious with regards to the Iranian war, and surprisingly you're seeing gold pull off this week. We're poised to snap a 4-week winning streak, with price reversing off of resistance that we were looking at last week, 53.42 into 53.43. That's a basic 786 retracement of the entire 21% drop that we saw into the close of January. And it's also the 100% extension of the advance off the lows that we marked in February. We tried to push through it on Monday, with Tuesday splashing back pretty hard. You got a 7.8% pullback, and that one candle now defines the weekly opening range as well as the month-to-date opening range. So the threat is for some more back-end fill within the broader uptrend. Some levels to keep in mind on the weekly chart. The high week close, the week that the record high was registered, the close of that week gives you 48.94. And just below that is the 618 retracement of that February rally at 47.91. That would need to hold for the medium-term bullish trend to remain viable, okay? So two levels to keep in mind. Now, the daily chart. Earlier in the month, we highlighted a setup on this, and we talked about the last two meaningful pullbacks that we saw in gold, namely the 11% drop we saw in October and the 10% drop we saw in April. In both instances, the pullback range, that is just the high to low for the pullback, held for at least 2 months before breaking higher. We're only about a month and a few days in here on the gold pullback thus far, which would suggest we still might have some more time of digestion from that massive January pullback before we actually get the breakout. So some patience is still warranted here. Support 50.31 is a basic 38.2 retracement of the February advance. If that were to give way, you're threatening a pullback towards the 200-day moving average. And again, bullish invalidation, still 47.91. That's 618 retracement. Drill down even deeper. Here's what the 4-hour chart looks like. It's the same pitchfork that we were looking at last week. You can see that the median line converged on resistance right into the start of the week at the 100% extension. Again, that was 53.43, and the high day close extends it into 53.78. That's the level we need to break to threaten another run at the record high, okay? So while below that, the threat is still for some back and forth price action, potential drop towards the lower parallels. Initial resistance is going to be at the 618 of just this weekly range, and the objective weekly and monthly open gives you 57 to 52.79. That's initial resistance. Initial support 50.31. Again, the February open converges on that high week close we just looked at on the weekly chart at 48.94, and bullish invalidation at 47.92. Now, if we do break that high day close, you're looking for still a stretch right into key resistance, which caught the record high 55.20 into 56.14. Some nice longer-term fib ratios there that caught the record high back in January. And a breach above that, you're looking for potential resumption of the broader uptrend. 57.67 is the 1618 extension, and then right up into 6,000. Now, you still do have some major event risk on tap into the close of the week with non-farm payrolls tomorrow. ADP yesterday came out stronger than expected, 63,000 versus 50,000. Challenger job cuts earlier today, also better than expected. So really brings the focus on non-farm payrolls tomorrow. We're expecting a read at 59,000 after a previous blowout at 130. Couple things to keep in mind. With the Iranian conflict really continuing to escalate, concerns have continued to mount that the spike in oil is going to hit energy prices and i.e., filter into the inflationary outlook. If the inflationary outlook continues to deteriorate, that's going to pause the Fed's willingness to cut rates. If you look at Fed fund futures now, June, up until this war started, was pretty much the inline expectation for the first cut. That's been kicked out now to July, and even July now is at a 50-50 rate probability for a cut. So if the employment figures come out stronger than expected and inflation is seen remaining sticky, or at least having upward pressure because of the higher oil prices, that might actually be better for the dollar and actually might prompt some continued gold weakness, right? Remember, gold does not give a yield And so higher interest rates may still kind of at least dampen the rally in the near term. Keep your eye on tomorrow's unemployment number. We're expecting to see a hold at 4.3%, and the participation rate is always going to be key there, as well as average hourly earnings, and that hits right into the close of the week. So we'll keep you updated, as always, on MB4X, but the main focus here is if we're going to get some more period of digestion, if that pullback range is still going to hold for that 2-month time period, we still might be in for a little bit of a grind here before the next resolute close. Losses should be limited to 47.91 if gold is going to maintain this uptrend, and we need to close above 53.78 near term, at least to give us another threat at a run at the highs. Till then, guys, best of luck trading, and we will see you next week. Cheers.